Hi, good morning, everyone, and welcome to the BPC. Thank you all for joining us today for an important discussion on the future of the oil and natural gas sector and its role in the transition to a net zero economy by 2050. I'm Sasha Mackler, and I lead the energy program at the BPC. We've got a great lineup today that is really well positioned to help assess how to align our long-term climate goals with our near-term priorities in the energy system. Let's start with a brief overview of the program, and then we'll move into the conversation. We'll start today with remarks from the ever thoughtful Kevin Book, which will be followed by a short discussion between Kevin and myself that includes your own questions from the audience. And then we'll transition over to a panel conversation on this topic with perspectives from a few leading experts in the field, where we'll also have an opportunity to fold in your questions from the audience as well. To frame this topic up a bit, let me just say that it's clear today that the energy system is facing an enormous transformation as climate policy forces gain momentum here in the US and globally. Renewable energy is mainstream, advanced technologies are emerging from the labs and entering the marketplace, and customers are demanding clean options. All the while, governments, including ours, are starting to get real about a policy agenda. And at the center of it all is the oil and gas industry, the workhorse of our current energy system. And now we're faced with a fundamental question: as the urgency of tackling climate change intensifies and tensions between near-term forces and long-term ambitions become more apparent. And the key question that we want to unpack today is, what is the role of the oil and gas industry in a net zero world? In the public imagination, the answer to this question, I think, falls into two broad categories. On the one hand, to hit our climate targets, these industries need to phase out over time. There's another perspective that suggests that to navigate such a complex transition, today's energy industry must be an active player at the forefront in delivering clean energy at scale. This divestment versus investment discussion is becoming increasingly relevant as we grapple with energy supply issues in real time. Is divestment from oil and gas the fastest route toward our climate goals? Or is an accelerated program of public and private investment in advanced technology that's driven by the oil and gas sector the most efficient and effective path? This is a real question. Climate advocates are challenging policymakers on all levels of government to divest. Shareholders are pressuring companies to substantially alter their business plans to shift away from fossil fuels. In the meantime, many oil and gas companies have announced substantial investments in carbon reduction technologies and are adjusting their portfolios and their strategies and calling for more engagement with the federal governments to implement policies to help with this transition. We've got a great group of speakers today to help us sort some of this out. We'll move to our panel discussion in a little bit, but first we'll start off with some remarks from Kevin Book. So let me just start off by introducing Kevin. He's the managing partner of ClearView Energy Partners, which is an independent research firm specializing in identifying and quantifying the risks for financial investors and corporate strategists in the energy space. He and his team rely on firsthand experience and a number of proprietary models to examine factors behind what's going on in the energy space. He heads the research team and covers oil, natural gas, refined products, and coal. He also has the talent of being both authoritative and funny, which are traits not often found in the energy world. And I always learn something when he shares his views, and I'm sure you will too. So with that, we'll turn over to Kevin, but let me just remind the audience to get your questions ready and to submit them using the live chat on YouTube, on Facebook, or on Twitter using the hashtag BPCLive. So with that, I'll turn things over to Kevin. Thanks.
Thanks, Sasha, for that kind introduction. It's good to see you. To those watching, my warmest greetings, whatever time zone you're in. COVID has made me chronologically correct, so I have to say that. Over the next 8 minutes, my task is to set up the discussion. I promise to be chronologically efficient. I hope to provoke questions. And I think I'm going to unpack a couple of the words that that Sasha used in his introduction, both transition and transformation. But as a starting point, let's start with transition, which I think is where the oil investment discussion begins. I'm not sure we can say when an energy transition began, because so many of the technologies and fuels the world is using for decarbonization, they were solutions for diversification when supply security was driving the discussion. And don't get me wrong, supply security still matters, as we can see. But transition is like a shift in priorities, a move from all of the above to best of the available. And at ClearView, we think of transition as having three parts: sentiment, technology, and policy. So sentiment, it's changed. I mean, I could point to many things. For example, we're having a discussion that includes divestment when oil is $90 per barrel. But there have been some signal moments in recent years, like the 2015 Vatican climate encyclical. No disrespect, but large institutions tend to be more trailing than leading indicators. And that was like the caboose of the trend train. And what about technology? Well, you saw in your invitation, 80% of global demand supplied by fossil fuels, even though renewables and electric vehicles are growing fast. We are hundreds of quadrillions of British thermal units and tens of trillions of dollars in capital investment away from a substantial transition. If those numbers seem big, too big to make sense, let me give another yardstick. What form does today's spare energy capacity take? Can we call up non-emitting resources during times of short supply? Not yet. When the world's short, it still falls back on fossil fuel, especially oil. So that takes us to policy, and that's really the tool that can close some of the gap between sentiment and technology. Very much a work in progress, and of course, why we're here today. So here are three framing questions. First, as Sasha's remarks, I think, hinted, are we asking oil and gas companies for transition or outright transformation? And I would suggest they are two distinctly different points on a continuum of change. Transition can be incremental, a shift into greener fuels and technologies. Transformation, like the evolution of Danish oil and natural gas into global offshore wind lead Ørsted, much heavier lift. That transformation grew out of uncommon circumstances: financial stress, technological skill, government support. A more typical transition pathway for oil and gas might be one that leverages core competencies. What are oil companies good at? They generally excel at subsurface geology, at safely operating massive infrastructure. They know how to deploy vast amounts of capital. They know how to do business with national governments. And for that matter, midstream companies have some battle-won experience at all levels of government, especially with permitting. Probably a separate discussion we could spend a day on. But where can that go? Yes, offshore oil and gas operation skill, that can translate to wind, but drilling and fracking can also produce geothermal resources. Refiners can make renewable diesel. And if you can convert one hydrocarbon into another, you can separate hydrogen from carbon. Companies that can extract can also inject, and midstream companies can build pipes for hydrogen and carbon dioxide. Getting outside core competencies is possible, but maybe not optimal. For example, an energy technology company that makes gas turbines might have a shorter path to hydrogen turbines than, say, to solar panels, because it sells things that spin, not things that shine. And why would an oil and gas company invest in solar? That brings up my second framing question. Will the policies driving transition be prescriptive, or will they be performance-based? At a high level, prescriptive policies specify inputs, and performance-based policies specify outcomes. And when it comes to rules and standards, that can make a big difference where money goes. Performance-based-ism, which I will just call pragmatism, can leave room for transition, while prescriptivism may demand more of a transformation. In a pragmatic framework, natural gas with responsible methane controls can be produced, liquefied, and shipped to displace coal. In that world, industry can lower the carbon intensity of existing fuels with renewable liquids and biogas, and also with carbon capture and storage on its own and through enhanced oil recovery. And that could have learning effects that read through to direct air capture. Blue hydrogen can energize hard to decarbonize sectors, but a more prescriptive framework might not leave room for any of those investments. The European Commission's green taxonomy offers a real-world test case of this situation. And I guess the inclusion of natural gas and nuclear power, well, it makes it look less prescriptive, but the story isn't over yet. So this takes me to my third question, which is whether oil companies will be the ones making the transformation and transition investments, or I suppose whether they will be investing at all. I say that because many of you recall the statement in the International Energy Agency's net zero by 2050 roadmap that, quote, there is no need for investment in new fossil fuel supply in our net zero pathway, end quote. While I'm quoting people, Special Climate Envoy John Kerry has called for, quote, capital flows that are consistent with the Paris Agreement, end quote. So what exactly does that mean? Well, it can mean encouraging green investment with tax incentives, debt subsidies, but it can also mean choking off investment to conventional fuels. That can happen explicitly through divestment campaigns, lending prohibitions, effectively boycotts. It can happen indirectly too. Higher lending reserve requirements, higher trading margin requirements, greater insurance premiums, all backed up by climate stress tests and disclosure policies. Either way, the mechanism of action is a higher cost of equity and debt capital for oil and gas firms. Because the supply curve for money, it's like the supply curve for everything else. It slopes upward. At a higher cost of capital, investments return less. At a high enough cost, some aren't worth doing. And in those cases, oil companies might just return capital to shareholders, and the shareholders can invest elsewhere. Which takes me to a few closing thoughts. First, it's not like you can wave a magic wand and turn pump jacks into pinwheels. I think we can see right now that not investing more in oil and gas supplies doesn't necessarily bring an instantaneous deployment of green energy. Mostly, it just leaves supply short and prices high. Second, crowding out capital doesn't necessarily eliminate the business case for fossil energy. Shortage-driven premiums could very well invite less regulated and less transparent players, or those with higher risk tolerances, to come fill the supply gap. And third, this is a bit esoteric, but raising oil companies' costs of capital could discourage transition. Let's say an oil company decides to turn hydrocarbons into dollars and then uses those dollars to buy or build green energy. If rules that financialize climate risk across that company's whole asset base, including legacy assets, raise its cost of capital, that company's green investments could underperform its pure play competitors. So, okay, look, I think we all know the bottom line is that transition is going to cost more than governments are likely to spend by themselves. With clear signals, durable incentives, and realistic targets, oil companies' investments and capabilities could make a difference. One could argue that a truly existential moment calls for pragmatism. And with that, maybe I'll stop and look forward to the rest of the discussion. Thanks, Sasha.
Thanks, Kevin. Really interesting opening thoughts. Appreciate that. Let me just say here, please share your questions with us and we'll try to fold them in here while we still have Kevin with us. But maybe to start off with a high-level question based on what you just kind of outlined for us all. Why do we see such a sharp divide between those who caution against divestment and those who believe it's necessary to happen immediately? And how should we think about the trade-off between our need for reliable, low-cost energy and our desire for decarbonized system in a few decades? What are those trade-offs to you?
Well, I wouldn't be probably stretching a lot of your credulity if I said this was a polarized time and a polarizing topic. And sadly, one that has become more of a litmus test in many cases of which side one is on than a discussion about where we can go to solve a problem together. The energy we have today is still very much a part of our lives and livelihoods. And if you look at the challenges facing Western governments, where particularly market democracies where there's accountability really have problems with shortage, it is getting in the way of a green agenda, whether it should or shouldn't. Investment is going to have to happen. Leaving the world short isn't really an option if we want to maintain our quality of life. And the urgency of the climate crisis, the urgency of the moment, has demanded brisk action, I think, from everybody who wants to act. And so the two are reconcilable, but they're not easily reconcilable. And there's some history too. Oil and gas companies have not always been everyone's favorite. I mean, maybe right next to your stuffed animal on the bookshelf, you have an oil and gas stuff, sort of a cushy oil and gas stuffed animal. But most people tend to not exactly love the industry. And the critics of the industry take issue with other aspects besides climate. They've addressed sort of the highly concentrated investment and returns. Some of these legacy issues, I think, become part of the discussion whether they should or shouldn't. again, in that more pragmatic framework that I laid out, a ton is a ton. And if it's not a ton that is a ton, then maybe something other than climate is at the top of your agenda.
Yeah, I agree with that. And if we shift from sort of that political frame, and we look at the data, what does the mainstream analysis and the projections tell us? My read of the of the latest work from the IEA and the EIA sort of suggests that there's going to be a continued role, obviously, for oil and gas in the next decades ahead. Are there disagreements there that you think are worth raising here in terms of the data and the answers around the path of the transition and how dependent we will be on oil and gas going forward?
I think there are pretty stark disagreements. There's been work done that says the transition, particularly in the electric power sector, could happen essentially costlessly within a very short interval, 10 or 15 years. And I think some of that work is credible. Some of it is probably hopeful, but it's a point of view that's been expressed. The transportation sector moves slower. And when we look at our transportation fleet and the turnover time for light duty or for anything else for that matter, 15 years is really the leading edge of aspiration. And we're looking at multi-decadal shifts. Particularly, we're asking questions, when we look at the data, we're asking the questions about who's going to pay and when, and will everybody everywhere have the same access to the same options? It is a global problem. And so when the wealthy countries can transition into cleaner energy technologies, particularly if the legacy technologies simply move to the less wealthy countries, ledgering one emitting source over to another category doesn't necessarily change net emissions. So there is a transition in progress right now. The sales of EVs, for example, are growing very fast from a small base. Every million EVs on the road is somewhere between 25,000 to 30,000 barrels per day of oil demand destruction. It's happening. It's happening now. The installation of green resources also moving very, very quickly on the grid. But there are some headwinds that are organic and intrinsic to that sector itself that have nothing to do with one's political beliefs. Factor cost inflation is happening because supply chains are freighted by COVID. There's some challenges right now connecting resources to the grid. When we look ahead at the scale of the transition that's been laid out, there's been a lot of good analytical work looking at all the metals and minerals that will be required, but not a lot of very clear answers about where they will come from or on what terms. A lot of debate centers around that too. So there's different trajectories. The last thing I'll say just about this, Sasha, is that time frame is everything. Over 30 years, fully depreciated assets can be changed out. Over 30 years, business models can change entirely. Staff, knowledge, core competencies that I mentioned, it can all be different. But 15 years is practically tomorrow when you start to talk about energy infrastructure. And so when we look at some of these interim targets at 2030, they are extremely ambitious.
Yeah, I think that's right. And when we think about kind of what is forcing the early days of the transition right now, what's your view on how much of it is policy driven and how much of it is driven by more secular changes in the market, or even from the ESG movements that we see today? There's a lot made of that in sort of the public narrative on what's happening in the sector right now. Do you think it's really having an impact on the business decisions right now in the oil and gas sector?
Well, it certainly is having an impact on business decisions, particularly for publicly traded companies. If you're hearing from investors that you're not green enough, there's probably going to be a proxy fight coming or some sort of initiative pushing before long, and that's important because it takes money going into the ground to get fossil energy or really any kind of energy out. It takes investment to generate energy from infrastructure and resources. In terms of the what's driving things, there are several categories of things that have happened. So I like to differentiate between the things that are organically, economically happening anyway, and the things that are only happening because they are meant to mitigate or prevent climate change. A lot of the anyway discussion centers around move from higher emitting fossil fuels to natural gas. That is happening anyway. And for a lot of the change here in the US, it was happening because natural gas provided an economic option. there's now any-way transitions happening in the solar space as well. Any-way transitions on wind, because organically you're seeing infrastructure that can be delivering electricity at a lower cost anyway. Although when you look at full system costs and battery backups, a wholesale transition may not be part of that pricing formula. But then when you sort of get past that and you say, okay, well, what about the other drivers, the ESG question that you raised? It's very fundamental. Look, there were socially responsible investors before there were ESG investors, and investors have an imperative, several. One, the most important one is not to lose the money they've been given to invest, but also to beat their benchmark. They're looking for performance. And so to some degree, there are some challenges when you see lower returning green investments that are performing less well than, particularly at a time of high oil and gas prices, fossil energy investments at the upstream in particular. And if you have investors that are reaching for performance, they're divided. They have a mandate to deliver for the fiduciaries, but they are also, particularly if their charters is put them into a green space, they're trying to find ways to make investments in low emitting or zero emitting technologies. And that is starting to really play out at a government level. We're now in the US asking questions about what disclosure requirements will adhere to publicly listed companies. And we're asking questions about even the funds themselves. Are there strategies transparent enough about how green those funds really are? Will we be crowding capital in by inviting more investment into green energy, or crowding capital out by limiting investment to fossil resources? Those questions are on the agenda for the Securities and Exchange Commission this year.
Yeah, and I'm sure we will unpack this question in particular in the next panel as well. Well, I'm going to fold in a few audience questions here that are starting to come my way, and this one is from Jeffrey Davis, who is asking about subsidies. And what he says is, you know, critics say that the oil and gas industry is subsidized today. What does that mean to you, and what is this so-called subsidy?
So this is the hottest and most divisive question. You know, as a mere undergraduate economics student, I learned one definition of subsidy, and then as an analyst many years later, I learned how not to use the word if I wanted to be friends with some people and not others. The answer is entirely subjective now, and maybe it shouldn't be. There is an official economic definition of subsidy, but I think there's a distinction between regular business tax treatment, which the oil and gas company does receive something that is essentially regular business tax treatment, and government outlays in the form of tax credits that are directed at trying to produce specific results. And again, definitionally, these things, maybe they shouldn't be, but they're very subjective. And you'll see folks on one side that group a set of government tax expenditures in one category and parts of the permanent code in the other. I'll see other people who group them all together. The question, I guess, at some level is, as we look at the government incentives that we provide writ large, we should be thinking probably in more standardized terms around a goal. And that goal, this has come up a lot, I've testified about this on Capitol Hill over the last decade, is sort of a fluid thing. Are we trying to energy security? Are we looking at government dollar outlays per millions of BTU that we have that is secure? Are we looking at government outlays per emissions reduction, a ton reduction? There's a lot of ways to approach this, but the code isn't aligned in a way that makes it easy to have a neutral discussion.
Yeah, that's a complicated one. When we, you know, we've been talking sort of broadly about the oil and gas sector, but let's see if we can parse that a bit. What in your view do do oil and gas have in common, and how are they different, especially as we think about the next few decades and our path to net zero?
Well, so, I mean, there are more gas-prone or oil-prone formations. You know, nature provided for that. There were lawmakers several years back who talked about gas-only wells, and I think a lot of people in industry sort of raised their eyebrows, like, what are you going to do, re-inject the oil? There's some differences in emissions properties. Certainly, you have a higher carbon intensity per million BTU in oil than you do in gas. But there's also differences in the requirements and usability for the resource when it comes to energizing society. Oil is readily stored and transported at atmospheric temperature and pressure. Natural gas requires pipes, ships, LNG, liquefaction and regasification equipment, much more capital intensive to move it around and harder in a lot of cases to store. And ultimately, I think what you're seeing is that the companies that produce from a given formation are using technologies that are applicable for both. So I mentioned, for example, geothermal. You frack geothermal formations using similar technologies to those used to produce oil and gas. So the technology toolkit and the companies may be the same, but increasingly what you're seeing is a sort of a climate-driven preference for gas as a solution. And associated gas that came out with oil from the Permian Basin turned out to be a very easy way to reduce emissions because it came out essentially extra. It was free. If the oil was what was being monetized, the gas would come to market very low price. Other places and in other ways, natural gas is sometimes more dear, and it doesn't always deliver. Today, we're seeing these very high LNG prices on the open sea, but in a more normal context, oil is more highly rewarded, usually, or at least historically, than gas on a dollar per million BTU basis. And again, a lot of that I think has to do with its application and its properties.
Thanks for that. We are having a few questions come in that are focused on nuclear energy and how that might be able to play a role here in the production of zero carbon fuels. Eric Smith is asking, do you have any thoughts on extending nuclear power to produce green hydrogen via electrolysis? Any thoughts on that?
Well, yeah, so hydrogen offers a natural transition pathway that converges with clean resources. There's a reason we're talking about hydrogen. We've been talking about hydrogen in other forms, proton emission membrane fuel cells, that kind of thing, freedom hydrogen in the Bush administration. A lot of talk has gone to hydrogen. But what it does is it's a molecule that can come from many different sources. It can come from fossil energy through blue hydrogen that captures carbon and sends out a low emission hydrogen. It can come from hydrolysis of water, and the hydrolytic process can be energized by electricity with zero emissions from nuclear power or renewable energy. And so it's this convergent pathway that it's much discussed and makes a great deal of sense, except that most of what we're talking about does not currently exist. Nuclear power has a lot of utility in the electric power sector right now from an emissions reduction perspective. My colleague Tim Fox has been writing for years about these plans to keep existing plants alive, even in environments where some of them aren't performing financially very well or even succeeding at generating profit. And the reason, of course, is a because reason, not an anyway reason. It's a because we want to have a climate benefit. A lot of the old discussion about nuclear power, when we, as a country, were bought into the idea of big new reactors instead of small new reactors, which is the current trend, was to talk about using the off-peak time when the clean generation was available for things like charging batteries. And so that off-peak time is still a reality in the way that we consume electric power, ups and downs throughout the day, peaks in the late afternoon, that kind of thing. And as a result, nuclear power could be used for hydrolysis as well. The one thing I'll say about all of this is that the pathway doesn't start building itself. And so those who look for the green hydrogen future can't necessarily ignore the hydrogen of today as a stepping stone to getting there and hope that there's going to be enough supply to meaningfully decarbonize those hard to decarbonize sectors.
Yeah, let's build on that policy question here a bit in the final few minutes. There's a lot of talk in policy circles about how really to drive this transition forward, pricing carbon is really the most effective way to do that, for very obvious reasons. At least here in the US, politically, that's not really on the table right now, although we do see some signs of that in other parts of the world. What's your view on the viability of a carbon tax, and can we start thinking about other ways in which we could start to price carbon? For example, the one that I'm quite interested in right now here at the BPC is border carbon adjustments. What's your view on how that could act as a proxy, the viability there, and the potential effectiveness?
Sasha, I'm glad you asked. By the way, if we're going to fight about stuff, we can fight about whether it's a border carbon adjustment or a carbon border adjustment. I'm in the latter camp. So look, a price is a price, whether you assign it at the border or whether you do it in the capital, right? The coastline is a perfectly fine place to put in a price and have all the effects of pricing carbon show up in your economy. And it's happening. One of the reasons to think that that might get ahead of actually a carbon tax fee or other financial mechanism in the sort of the legislative context is that it looks like it can be done using Section 232 of the 1962 Trade Expansion Act. Maybe we can retrofit our steel tariffs to become sort of climate border adjustment tools, do it in concert, a carbon club with the European Union, which has an explicit carbon price, join a carbon club with Canada, which has an explicit carbon price, and maybe do so even without necessarily having one of our own. And the price sort of backs into our economy, washes ashore, if you will. The interesting part, though, is I think that once we start down this road of trade-mediated climate mechanisms, carbon pricing mechanisms, it may not be long before our lawmakers start to look at things a little bit differently. No, it's not likely that I think you're going to see a lot of enthusiasm for carbon taxation on Capitol Hill. But when it starts to become a fragmented world, sort of clawing at one another across national boundaries for what has been a very messy sort of trade war environment, potentially getting worse after all this fiscal stimulus, defending what we've spent that money on is going to make things probably a little bit more trade war conflict like. Then you might start to see that actually having a price of your own can indemnify your exports into regulated markets. Lawmakers maybe won't call it a carbon tax or even something that mentions the climate. It'll be a commercial freedom fee. But we might see our way to that mechanism as the European Union begins to make its border adjustment mechanism. Canada makes its border adjustment mechanism more robust as the carbon adjustments for steel and other heavy industry goods start to become more of a reality. So it may not be our starting point, but again, a price on the coast can work like a price in the capital.
The carbon freedom fee, I like that. I'm gonna use that one. So one sort of general question here to wrap things up, because we have to move on to our panel. Would love to just get your final thoughts here on what you think the oil and gas industry is going to look like 3 decades from now.
Well, so I think it's going to look like very much a big part of the investment picture for energy. I think we don't know yet whether any of the goals that the aspirational targets have been set out are likely. Much of that, I think, will depend on anyway solutions that are economic anyway, and also the will of populations to withstand price disruptions, uncomfortable price premiums along the way. I suspect that we're probably not going to be as green as soon as those who would have it would hope. And as such, we may be producing more oil and gas, maybe less hydrogen than some of the models that set net zero targets out in 2050. But I think these skilled resources that you have in terms of corporate cultures in managing large infrastructure projects and contact with the subsurface is going to keep the oil and gas industry very relevant and a very big part of the story in 3 decades. My usual horizon is about 18 months, Sasha, though. So I'm a little myopic for the last, 28 and a half years.
Thanks for that. I think we can all relate to that. Well, Kevin, very, very appreciative of your time today. Thanks for sharing those thoughts and reflections and for helping to tee up this conversation here. We're going to transition to the next panel, so thanks. All right. Well, now we're going to move on to the second part of the program, where we're going to fold in a little bit of a conversation with a great set of speakers. What I'll do first is just introduce each one before we move into the conversation. Real quick, I'll start with Sarah Ladislaw. She's the managing director at RMI, where she leads the U.S. program there. She was previously senior vice president of CSIS, where she led the think tank's work in energy policy, geopolitics, and technology analysis. She spent time at the Department of Energy and has a long history on the geopolitics of oil and gas and on clean energy. And we're really excited to have you here with us today, Sarah. We also have Bruce Niemeyer. He is Corporate Vice President of Strategy and Sustainability at Chevron. He's responsible for guiding the development of the company's key strategies, including capital allocation and sustainability efforts. Thanks for joining us today, Bruce. And finally, we have John Larson, who is a partner at the Rhodium Group, a firm we all know well that helps us understand what's happening in the energy and climate space here in the US. He leads Rhodium's US energy system and climate policy research. He's really a well-known expert on a lot of the trends that are going on right now in the energy space. So thanks to all of our panelists for joining us today. What I thought I'd do is start off with a big picture question for each of you, and then we'll move into more of a conversation. And we'll start with Sarah. And I also like to just remind everyone, please get your questions teed up and sent over, and we'll try to fold them into the conversation as we move through the next 30 minutes or so. But Sarah, starting with you, what's your view on why we see such a sharp divide today between investment and divestment? And what I really would love to hear is your understanding of the energy system today and your thoughts on how it needs to pivot to address the sort of net zero challenge that we face.
Yeah, thanks very much. And thanks for the opportunity to be here for this important discussion with some really thoughtful and admittedly, yes, Kevin is quite funny as well, people to have this conversation with. So really quickly, like, I don't think this is a new tension. This has been, something that we have dealt with for a number of years. I think it is feeling particularly acute because of the way in which we understand the timeline for an energy transition, right? This is not some abstract construct of like, everyone agrees over time that we're moving towards a suite of technologies and away from a suite of technologies that we've been using and fuels that we've been using, for the last, multitudes of decades. The issue is that we have a timetable to do this under, right? So pace and scale are real issues in the debate about how we spend our dollars in the energy sector. And so right now, I think for policymakers, for industry, for investors, everybody has been pushed closer to not a question about what you intend to do by 2030 or even what you intend to do by 2050, but like what you're doing with your dollars today. Right. So the level of scrutiny on investment decisions for literally everybody in the energy supply and demand value chain is much higher. And so I think that sort of puts to the fore the question of, not only for, companies, how they're adjusting their strategies to make sure that they're part of navigating a system to something that is fundamentally cleaner that we know we need to get to, but also for investors, And so I think what has happened is very few people have confidence in like a stable return on investment for fossil fuel related investment dollars over a long period of time because, as Kevin sort of pointed out, we don't live in a neat policy environment, right? If you're looking for a stable transition, like the only thing I can offer you is a DeLorean and a flux capacitor to completely date myself. We had an option to take that route. We are in a not neat policy environment with, where we're behind on almost every metric in this transition. So it's going to be tense. And I think the imperative here is to figure out how that tension doesn't drive investment away from the energy sector, but to the energy sector in places that we've all agreed we have to go towards more quickly. And so I think that's the most productive place to exist in that conversation for everybody, though I do understand the near-term imperative of trying to say, okay, what happens when we're in a particular point in time where we have high energy prices in the conventional energy system, and we have underinvested in the kinds of things we know we need to be going to, and it's going to take a minute to get to those things. And I think that's an area for real and legitimate policy discussion that we see many governments sort of partaking in, particularly in this current moment. But I think the longer term question is, how do we boost the confidence in the types of things that we know we need to be moving towards and really make it an investment discussion in that sense?
Yeah, that's great. Speed and scale, it's really the imperative here. Bruce, let's turn to you. And building on Sarah's response and what we heard from Kevin earlier, would be really interested in hearing Chevron's view, in particular, how you're approaching this sort of long-term energy transition question. I know Chevron has made a number of recent announcements in terms of its priorities and its capital allocation. And would love to just hear how you're thinking about the long term.
Thank you, Sasha, and it's a pleasure to join Sarah and John on the panel today. And maybe just to level set everybody in terms of who Chevron is. We're a global energy company. We've been around for 140 years. Specific to today's discussion, we are engaged in oil and gas and all forms of that value chain. We produce crude oil and natural gas from wells in our portfolio around the world. We transport it. We turn it into the products that consumers ultimately utilize through our manufacturing processes. So, diesel, gasoline, jet fuel. We're also invested in new energies, in renewable natural gas and renewable diesel, sustainable aviation fuel, hydrogen, carbon capture. We have venture investments in nuclear, in charging technology and batteries. And so it's from a pretty long dated and pretty deep and global experience that our point of view, emerges. I think it's also important to acknowledge that we support the Paris Agreement. We have for a long period of time. Not everybody knows that, and the ambitions that it contains. And we think the future of energy is lower carbon. And that informs our thinking about capital allocations and the sorts of investments that we make. Oil and gas is in demand today. It's actually rising today as we emerge out of the pandemic, which has created certain sorts of challenges in the world. And as you look at scenarios that try to anticipate the future, one thing that I'm struck by is how common they are in seeing energy of all forms, even in 2050. And it really suggests that we need solutions across all energy forms in order to deliver the ambitions of Paris. So in the near term, we see markets and consumers in those markets most interested in energy that is affordable and reliable, and on an increasing basis, ever cleaner, and meaning lower carbon. And in the near term, that it creates a clear need and demand for oil and gas supply. And so, we are investing in those in a way that is, improving return and lower carbon. And in the near term, investing in things that directly build on our capabilities, our assets, and are connected with our customers. And for us, that's allocating capital to renewable fuels, to hydrogen and carbon capture, which we think are going to be important parts of the solution going forward. But at the end of the day, I think as a society, we have to recognize the importance of a variety of energies that are going to be necessary to reach the ambitions of Paris as we work towards that shared desired future.
Thanks, Bruce. And John, we want to fold you into this. You've heard a lot of the discussion here, and I know you have done a bunch of work from an analytical perspective on the transition. I want to get your thoughts here at a high level. What are your reactions to what you've heard, and how do you think about the transition, especially keeping in mind the need for reliability today and the geopolitics that we have to keep in mind as we think about energy policies?
Sure. Thanks, Sasha. And, just thanks again for having me on this panel. And it's a great discussion and a great group of folks. So really excited to be here. I think one way to think about this is just really kind of looking at the contribution of oil and gas to the climate change problem today, right? So oil and gas, when you count all the upstream methane emissions from production and all of the emissions associated with combustion of oil and gas products, at least in the United States, is about 75% of total net greenhouse gas emissions. So 75% of the US decarbonization challenge. It's a slightly lower number globally, but still similar magnitude. And so it's pretty obvious that the US and the world isn't going to tackle climate change without some sort of answer to how the oil and gas industry is going to transition over the next few decades. And even looking at some real policy responses that are kind of currently under discussion here in the US, we've looked at really closely at, say, Build Back Better and all of the package of investments and tax credits there, and even a bigger, more expansive policy response that we put out in a report called Pathways to Paris last fall that looked at kind of a full suite of policy actions by Congress, executive branch, and the states that was consistent with getting to the US target of 50 to 52% below 05 by 2030. And what we found was that US oil production is pretty much the same in 2030 as it would be without any of that action. And natural gas production is down by about 10% compared to a world with no climate action. Now, why is that? Sounds kind of contradictory to solving climate change, but the answer is most of the early tons that are going to really matter to getting up to speed and accelerating the clean energy transition happen in the electric power sector, where wind and solar will play a big role, and that basically will displace some gas. But also, even with getting up to say 50% EVs as a share of total light duty vehicle sales by 2030, that displaces about 15% of total petroleum demand in America by that year, right? So like, this goes back to Kevin's point. This is going to be a multi-decade adventure if we do it right, and it's in that way we need to be thinking about this transition in light of longer stock turnover times and lots of different moving parts here. And I don't think that means that right now people should be shying away from asking how investment needs to shift to get from here to 2050. I think Sarah's point on that is right. And I think policy has a big role to play, not just in focusing that investment where it matters most for the kind of the near-term transition, getting all that wind and solar and other battery, EVs on the road, but also in developing all these new emerging clean technologies. I know BPC has done a ton of work on this. We are not going to see that next wave of decarbonization by 20, even if we get to the 50 to 52% target. We're not going to see that next wave of decarbonization if clean hydrogen, long duration storage, advanced nuclear, all the other technologies you hear about, direct air capture, are ready for prime time. And oil and gas has an opportunity to play a big role in that space, should it want to. I think somebody needs to be playing in multi-billion-dollar scale to get those technologies off the ground.
Yeah, thanks, John. I think it's a really, really important point you just made, that the skill sets and the capital and the engineering capabilities needed to deliver the advanced energy technologies at scale could be a real opportunity for the oil and gas industry to step in and help to bring those systems and infrastructure forward. And so that's one of the arguments for this investment approach. I think that we sort of look at from the BPC's perspective. And Bruce, maybe just to turn back to you for to react to that point, and maybe to layer on an additional thing for you to react to is, I've read that Chevron does not use the IEA net zero by 2050 scenario in your own business planning, because you take the view that that scenario is remote. And I'm curious to hear your reactions to that, and then how do you think about that 2050 timeframe and your reactions to how IEA has sort of outlined it, or EIA, I should say.
Yeah, I think you might be talking about the IEA.
IEA, sorry.
Yeah, we use the same three letters in different orders. Overall, it's important that the oil and gas sector and participants in it are part of the solution going forward. As John was alluding to, the capabilities that exist in our sector, and I'll just take Chevron as an example, are pretty deep. We are problem solvers and have been for decades. And there was a time as a society, we talked about peak oil, meaning we were going to run out of the supply of that. And that's no longer a question that is raised, in part because of the application of technology, the ingenuity, problem solving that have occurred within Chevron and in companies in our industry has taken that question off the table. And society has moved, and they're thinking about other things and a different realization of the future. The scenario, and if you look at IEA's actual traffic lights on that particular scenario, and by their own description, they describe their particular scenario as having a very narrow pathway, and there's a lot of challenges associated with it. But we spend more of our time thinking about how can we provide solutions and bring things to the market that productively move us forward. So in addition to work on our traditional business, where we expect to spend $2 billion further decarbonizing our existing oil and gas business, which are things we can do in the near term, $2 billion between now and 2028. We're spending $8 billion on bringing to market lower carbon forms of energies or things in support of the energy transition in renewable fuels and hydrogen and carbon capture, with targets associated with all of those that are pretty ambitious. And the renewables fuel target, as an example, would allow us to provide renewable forms of diesel for all of our West Coast operations that we provide today and all of the aviation fuel that we provide to customers today. Which is ultimately a meaningful step. And those are things we can scale and deliver today because they build on capabilities we have. We produce today renewable diesel in our refinery in Southern California. We operate a carbon capture project in Australia. That experience will build on as we invest in other carbon capture projects around the world. And we produce 1 million tons of hydrogen a year in our existing operations. We're looking to expand that into heavy duty transportation, into industrial uses, and into power generation through a new organization that we stood up last year. That's all near term. And then there's a variety of venture investments that we're engaged in to fill the pipeline. Because one thing that it was referenced in the IEA scenario, half of the technologies that scenario depends on are either in the prototype or demonstration phase. And it really is a reflection. We need more innovation as a society to accomplish the ambitions of the Paris Agreement. And we have to be making those investments now. And a company like Chevron can take good ideas, and we have an operating footprint where we can test those and see those ideas develop and get to scale and become realistic options for us as we think about decarbonizing the energy system going forward.
Thanks, Bruce. Sarah, turning to you for some more of your thoughts. One of the things that is brought up a lot when we think about the role of oil and gas in the transition is kind of what we just witnessed in the pandemic, and how the global oil markets and the experience there might provide a lesson or for the transition more broadly, because we did see a rapid pullback in supply, and that led to, as we're seeing now, some price spikes. Is that too simplistic a view in your mind? And if high prices are a feature of oil underinvestment, does that say anything about the transition? And what are your thoughts there, and on global equity considerations if you're thinking about high prices? Is that something we need to look to expect?
Yeah, thanks. I don't think that the pandemic experience is a perfect analogy for the energy transition. I think it was an opportunity to perhaps, particularly on sort of like the green stimulus and recovery side of the equation, to steer things in a different direction. It's not so often that you've got, governments around the world putting trillions of dollars into the economy in a directed way. And so I think for me, that was the real experiment that came out of the period of the pandemic as it related to the energy transition. I think on the oil and gas side, it was kind of a remarkably difficult period of time to navigate through, right? I mean, it is not an industry that, hits the brakes that hard and then goes back to, a very strong recovery. So I think it is fundamentally one of the reasons why we're experiencing high prices today is sort of the machinations that the industry sort of had to go through. And if we rewind our brains a little bit, even before we hit the pandemic, there were, pretty big fundamental questions about, the investability of different oil and gas resources around the world that we were grappling with at that time. And so I do think it's a much more sort of complex experience that we've gone through that has something to do with pandemic economics as opposed to just being about the energy transition. And so I think it's being over simplified in that way. I also though think, and we've heard some recent sort of public comments on this, that there's some sort of presupposition that a world where we're transitioning away from fossil-based energy resources with unabated emissions is going to be a low-price environment for those fuels. I don't think that's necessarily true at all. And in fact, I think it could be a period of very high volatility in those markets, which I think makes the investment story even more difficult, unfortunately. And so I think the question really is, how do we as a society sort of even out some of those, those issues as we're navigating this transition? I also I'll get to your equity question very quickly, but I just want to say we're kind of talking about the oil and gas industry like it's a monolith, and it really absolutely isn't. And so the transition in the different parts of this industry are going to be experienced very differently. And I will say the sooner we get into discussions about which parts of the industry are most poised to be able to be part of a transition and in fact drive a transformation is one part of this discussion. And then there's a whole bunch of aspects of the industry that simply won't survive in a deeply decarbonized net zero environment. And we have to think about some of the equity issues associated with that, both for those communities and for those countries, for whom both the impacts of a changing climate and the changing economic implications of a net zero environment is going to be a real transition issue that we have to manage. On the last issue, listen, I think we need to start thinking about the price for energy services and the reliability of our energy system in much broader terms. Right now, we're thinking about oil and gas volatility and the impact that that has on delivered energy prices. But as we progress over the next 8 to 10 years, we're really going to be grappling with issues that are associated with all of the transition costs that are going to come from both the fact that we underinvest habitually in the reliability and resilience of our energy system, right? We like efficiency and low cost. We care far less about making sure that the system, as a policy matter, is as robust as it could be and as it will need to be, particularly for the kind of impacts we're going to see from a changing climate and the kind of sort of system transformation that we're going to need to go through. And so I do think, in a weird way, my new job is much more focused on climate change than my old job, which was really focused a lot on sort of energy security and geopolitics. But I think what we're falling short on right now is really thinking about what security and reliability looks like in the context of a transition. And I don't think that's just a story about oil and gas price volatility. I think it's a deeper, more complex story that we're going to have to become better at addressing, both as industry and investors and policymakers.
Thanks, Sarah. Yeah, that's a great point. And I saw, John, your head was nodding. So I'd like to turn back to you, get your thoughts on that, and in particular, your view on, is there a tension between reliability and these long-term emissions reductions?
Yeah, I mean, there's a couple things to think about here. I mean, first of all, like there's definitely a policy role in the reliability story that we saw this in Texas last year. If regulators don't require weatherization of critical infrastructure, then the weather gets nasty, things start to break. And that, that's different than, is there enough supply, right? Like that's, you just don't have that security of supply. Those kinds of challenges aren't going to go away if we are large, up to like 80% clean generation, because you're still going to want that gas peaker ready to go when things get tight, right? And you're going to want that supply and that security. And I do think the other thing to remember is, most, at least in the regards to the electric power sector, almost all the actors have the incentives to do the right thing and make sure the lights stay on. Like that's the job of the RTOs, that's the job of the distribution utilities. But when they aren't required or aren't incentivized to make the right, all the investments Sarah was just talking about, then they're gonna do just enough, right? And maybe that's not a 99.99% reliability record if you're doing just enough, right? So that's a key thing to think about here. Looking broader across the energy system, I mean, Kevin mentioned early on that the IEA said a net zero pathway means we don't need to invest in oil and gas anymore. That's totally true if you make sure you're doing a commensurate investment in reducing oil and gas demand across the board in every place in lockstep over the next 30 years. And we are way behind on that part of it. I mean, we should have way more electric vehicles on the road now if that's going to be the case, right? Just one example. Forget about, there's no solution to how to decarbonize buildings at scale, at least a policy solution in most jurisdictions. And that means we're going to need to think about how we continue to meet our emission reduction goals while maintaining that balance on price stability and affordability on the fossil side. If we had some sort of benevolent central plan dictatorship, you could be like slowly moving demand and supply down the chain as we hit net zero. That's not going to happen, right? So like, we've got lots of different actors. It's a dynamic global economy. Most of the time, policy is not up to snuff in driving the incentives we need to see everywhere. I would argue that, if Build Back Better does make it over the finish line, that's going to make a big difference in the US story. It's probably not nowhere near enough in and of itself to get there. And I think, as we move forward, in particular in this kind of polarized US legislative time, figuring out solutions that are going to both get the emission reductions we need while managing this balance around reliability and security is going to be, and affordability is, I think, a really huge challenge, and one that I hope we can tackle.
Yeah, huge challenge, and I think really calls for kind of a new moment of public sector and private sector sort of collaboration on how we navigate this transition, which is I think, as we're revealing here in this conversation, going to be an enormous task. Well, we're sort of reaching the end of the discussion here, and I want to make sure we fold in some of your questions that are starting to filter in from the audience. I have one here from Jeremy Pear, who's asking, are the Citibank actions to divest and BlackRock's recent postings, are they having an impact on firm behavior? Would love to hear, from any of you on this question, but why don't we start with Bruce, because you are coming from the corporate perspective here.
Well, we engage with our shareholders year round. Our independent directors engage with shareholders, our executive team. We've got a dedicated investor relations team. We have an ESG team, and that feedback is very important to us. And engagement, does shape the way we think about things, the things that we invest in and we don't invest in, and the feedback we've gotten from our shareholders on our existing investment choices has been very positive. Divestment, by contrast, it just changes who owns assets. It doesn't actually reduce emissions necessarily, and in some cases it might put emissions in owners' hands that are less responsive to engagement overall. So we found engagement to be very helpful, and feedback that we have gotten from our shareholders to be quite constructive in the way that we go about our business.
Sarah, do you have views on that you want to share?
Yeah, I think I actually think we're in a pretty important moment in understanding what the investment community is going to do with the same sort of pressure focused on them in terms of getting their portfolios net zero aligned, right? So if you look at the Glasgow Financial Alliance for Net Zero, 450 institutions covering 45 countries, $130 trillion in assets. How they decide, and if you saw the BlackRock, guidance that was put out, right? They said some people are going to be navigating this transition, some people are going to be driving it, and some people are going to be inventing new technologies, right? So trying to at least categorize the way that they're thinking about different financial stakeholders in assessing their role. The arc of the narrative thus far on investors has been get a small group of, very forward-leaning investors to, put limited amounts of sentiment pressure, to use Kevin's word, on companies to at least make a compelling story about how they're, navigating these risks, to one where those investors, and a full, suite and variety of them, are now being asked to make sure that their investment actions are aligned with their own net zero trajectory. So what it does is, Sasha, you just said, this is going to be an interesting time for public-private sector engagement. And I think when people think about that, they go, oh yeah, this is going to be like, we're going to do public-private partnerships and demonstration plants and those types of things. Or it actually means like in absence of policy, companies and investors are going to start taking the public good into their considerations, which gives governments fundamentally far less control over the decisions that they make. And they're going to start driving decisions in that way. Now, they obviously do have to continue to think about returns and all of these other things, but it means that like the environment for rewarding positive green behavior and being able to illustrate, good returns on those types of investment is going to be given a premium, right? And that's a different place for us to be. With that much capital focused on that kind of behavior, we could be at a real transformational stage for, quite frankly, like anybody who can prove that they've cracked that code. And what it does is it means that like nobody involved in today's energy system is inevitable, right? If you look at the scale of transformation that needs to happen by 2050 and the amount of money that has to go into making that possible, it could just fundamentally transform the energy system as we know it today. And for capital to be able to identify those opportunities is perhaps the most catalytic part of what's going on in the energy transition today. So I think we're at a real, potential tipping point. If that money meets opportunity, then I think that it's really just about us, keeping up.
Yeah, no, and that to me raises some really interesting questions around how do we define the goals that we want to reach? Like, what does net and net zero actually mean? And can we get a common understanding of that so we're all sort of driving towards the same outcome? I think we're not quite there yet. But John, would love to hear your thoughts on this question.
Yeah, I mean, actually, just picking up on your last point there, I mean, that's going to be a key part of, those definitions are going to be a big part of how those investments and shifts go, right? Like, I mean, if we're talking about zero in the sense of no more combustion, that's a totally, which I don't think most people are talking about, but just to look at the extreme, that's a totally different world than a net zero world where, you have some existing emissions at the end of the day and you are offsetting it through natural carbon dioxide removal or direct air capture. I think, at the end of this, it's worth noting that, there are some emissions that are really hard to get rid of. If we aren't thinking about a holistic set of technologies and solutions and policy frameworks to value them, that enables that kind of balance where we can actually have a thriving multi-gigaton negative emissions industry, for example, to offset whatever's left at the end of this, we're not going to get there. And to Sarah's earlier point, those kinds of investments and strategic decisions start now, right? Like this is where we're going. And if the kind of engagement that Bruce was just saying is so helpful could help foster a broader discussion and vision around that, I think that could really fill a huge vacuum where, honestly, policy is just not there right now.
Yeah, well, we are approaching the end of our conversation here. So thought maybe we would just wrap up with a final question to each of you. Maybe as a little prelude to that, the work we're doing here at BPC, we really think about this transition to net zero by 2050. That's really 1 or 2 investment cycles away if you think about how long-lived infrastructure is, and the imperative to get things right now and to be really charging ahead towards the technology and infrastructure deployment that we need in time to hit our goals is in our view just such an important and difficult question. Not impossible. We're very bullish on the fact that that's the right goal and that we can actually get really close to achieving it. But we see sort of the world's largest logistics companies, well-capitalized energy companies as really needing to be at the table and really driving us there in an accelerated way. And from our view, that's really probably needs to be part of the solution. And so what I want to ask each of you is what's your take on that? How do you see the oil and gas industry looking, 3 decades from now? And Bruce, why don't we start with you?
Well, I think engagement and having everybody at the table is extremely important because we've learned nobody's as smart as everybody, and you're going to need a variety of perspectives in order to solve solutions of the future. I think the future energy industry is more consolidated. Future oil and gas segment is more consolidated than it is today. It has to be high return, meaning it has to have successful financial outcomes to attract capital inflows. Even the IEA's scenario we talked about earlier has about today's level of capital expenditures in the 2040s to meet the then necessary oil and gas supply. So there's a continued need for that, but it must be lower carbon. If you look at IEA's data on carbon intensity for oil and gas, there's a broad range across the world, and increasingly the world is going to need the oil and gas that it uses to be sourced from the most efficient carbon intensity operations from the most efficient operators. And that's something that I think will also describe the oil and gas contribution to the Paris ambitions of the future.
Thanks, Bruce. Sarah, we'll turn to you. Final thoughts.
Yeah, sure, thanks. So again, I sort of said this before, I really don't think any industry is inevitable, right? So I think the question is, are we talking about the companies or are we talking about the fuel, right? And so the fuel has an imperative, and the imperative is, can it make itself fit in a very strictly low carbon environment? And there's lots of technological transformations that we have options and pathways for that to be true. And I think that the folks that work with those fuels today are very well positioned to try to think about new ways of not just making those fuels more compliant with a net zero environment, but also to figure out how to make money off of that, which is sort of important as well. And so I do think there's a lot about the industry that is well positioned to do that. I think that there is still a great deal of skepticism over whether or not, at least I'll speak for myself, whether or not the industry has really believes that there's a first mover advantage to solving those problems. Whereas I think people outside of the industry, sort of the conventional oil and gas industry, absolutely see a first mover premium in disrupting those models. So it is kind of a race, right? And so I think that what I think we can safely say will be true is that the sort of the window for operating, if you're a publicly traded company in the oil and gas space is going to narrow over time, right? The bar for your sustainability is going to just keep going up and up and up. And there's going to be, differentiated markets for your products. There's going to be regulation and trade barriers and all these other things that are part of the operating environment. The question is really like, how quickly can the industry illustrate its capability to do some of these new things that have larger staying power in the future of the energy industry. And I don't think any of that is guaranteed. I think it is genuinely sort of the next frontier for those companies, and we'll see how it goes.
John.
So I'm going to take a different approach. So if you do look at the net zero modeling that's all out there, and you look at 2050, and you look at let's say the world actually solves this problem, right, and actually gets there. In that world, you've got most end uses electrified. You've got most electricity coming from zero emitting sources like wind and solar and nuclear. And you've got the remaining fuels that are out there are mostly sustainable, drop-in hydrocarbons, but not from petroleum, right? Like biofuels and electric fuels. In that world, if oil and gas industry or the companies are playing their cards right, they are the purveyors of those low carbon liquid fuels that aren't from petroleum anymore, but still require refining capacity and other production capacity that they're good at. They are the carbon management industry of the world that is capturing CO2 from industrial sources that are other point sources and managing that underground, as well as a multi-gigaton carbon dioxide removal operation around the world that's pulling CO2 out of the air. And that is still like a multi-trillion-dollar enterprise that I think could be quite profitable and could look at the kinds of returns that investors are used to today, again, if they play their cards right. But policy may not get us to that world, right? So like, let's rewind from that, right? So let's say we don't electrify fast enough. Well, then petroleum is going to play a role, right? Like that's just the way it's going to be. And let's say buildings are still relying on gas fuels to provide heat and hot water. Maybe some of that's renewable gas, maybe that's electric fuels, but maybe it's fossil. Well, then the answer to that is you're going to need even more carbon management on the carbon dioxide removal side if you're going to get to the net zero world that we all want to see in a stable climate, right? And guess what? That's the same industrial players providing that carbon dioxide removal service, just at a bigger scale, right? So this, I guess my point is, these companies are operating and playing a role in that global energy system, maybe a very different one that we talked about today, but still one that is quite substantial and influential and important to making sure that we get to a stable climate.
Well, we'll have to leave it there. Very interesting conversation. I really want to thank each of you for your thoughts and reflections and taking the time to join us. We're at the beginning, I think, of a really interesting period of time here, as we've all kind of just described. Lots of questions that I think are still out there. Would love to keep going and actually turn to some of the policies that I think could help get us there. That might need to be a future conversation. But really, thank you for joining us. Thanks to our audience for being part of this conversation, and we look forward to more of these going forward.